business out of the way. Yes. Oh, the link to the recording will also we hope to make that available in the not too distant future. We're working on some technical issues to get those ready for you guys, but we plan to have those ready for you soon. All right, let me share my screen and we will get rolling here. All right, hopefully you can see my screen. Oh, hang on. One moment, technical difficulties, please stand by. Okay, now hopefully you can see my screen. All right, so what are we doing here today? The objective of this training presentation is to help you guys understand all of the different requirements as it relates to fees and financial assessments, so you can make sure that you're compliant with Title IX. In this session today, this is part 2. We did part 1 2 weeks ago, and I hope that you all were able to join that or review the slides from that presentation, because today we're going to continue on from there. We will revisit the valid income sources and income verification documentation. We touched on that last time, but we'll get a little bit deeper into those details today. We're going to learn how to properly conduct the financial assessment in order to determine a participant's payment schedule. We'll talk about financial reassessments, and then we'll look at some of the deficiencies that we see frequently when we're in the field. So just to remind you, there are 2 sections that really talk about participant fees and financial assessments. Financial assessments is first introduced in section 9878 when we talk about participant fees. And then section 9879 dives into the details of the requirements around the financial assessment. And the assessment, of course, is used to determine a participant's ability to pay the program fees. So there are some other places in Title IX that refer back to these requirements, but in this presentation, we're really going to focus on these 2 sections, 9878 and 9879. And throughout these slides, when you get a copy of the presentation, there are links, a bunch of hyperlinks to all of the different sections that we're referring to. So when you review the slides, you can click on those links and look up the regulations specifically. So last time we started at the beginning and went through participants' rights for a financial assessment. We covered what it looks like for a participant to request that assessment, what kind of documentation is required for that, how the program, you guys as the programs need to inform participants of the requirements, and that you have to schedule those assessments within 5 days. So today we're going to cover the topics that are highlighted in yellow here, and we're going to go through performing the assessment, making an income determination, determining a payment option, and then saving all of our records. So let's get into the fun part, actually conducting the financial assessment. Now, as we go along here today in this presentation, we're going to have some fun little quizzes that we'll do that will just kind of assess where everybody's knowledge is on different topics. And it also is kind of fun. You get to engage. So when my colleague pops up the poll like this, you'll just choose the answer that's applicable. Okay, so quiz number 1. A participant's girlfriend supports the participant. Can you consider the girlfriend's income when conducting your financial assessment? Yes or no? Just click on your answer and hit the submit button, and then we'll see real-time response. Okay. It looks like the majority of you say no, although some do think yes. So the answer to that is actually no. You cannot consider the girlfriend's income when conducting the financial assessment. According to Section 9879E, You can only consider the income of the participant themselves or any person legally required to support the participant. So here in California, that is their spouse or parents of minor children or legal guardians of dependents. So you'll take whatever that income is, you'll look at all of the different sources of income that the participant provides evidence for, and then you'll determine what their monthly income amount is. And we really want to drill down to make sure that you're looking at their monthly income because that is the unit of measure that the regulation uses. So you'll want to figure their monthly income amount. All right, quiz number 2. Does CalFresh count as income? Yes or no? CalFresh. Is it income? Let's see what you guys think. Okay, the overwhelming majority of you know that the answer to this is no. You cannot consider CalFresh as income. What do we get to consider as income? So Section 9879E is very specific about what we can consider income when we're making when we're doing the financial assessment. So it tells us that we can consider somebody's wages, their salary, bonuses, commissions, and tips from a job, compensation for work-related expenses that are in excess of the actual expense, any net profits that they get from self-employment or income from your real or personal property. You can consider spousal support, Social Security payments, retirement income, unemployment compensation, strike benefits, workers' comp, veterans payments. You can consider grants, educational grants or stipends for training. And then, of course, there's various forms of public assistance that you can consider. And these are probably the most common ones that we see for folks requesting financial assessments. And these include CalWORKs. It used to be called Aids to Family with Dependent Children, but this is what we call CalWORKs in California. You can consider SSI, any other emergency assistance money, and of course, non-federally funded general assistance or general relief payments. And we're going to call that GA or GR throughout this presentation, but that's what we're talking about is general assistance. So here's a critical thing to remember. You must document the financial assessment. Every financial assessment you do must be documented. And this needs to show when the assessment occurred, what income documentation you looked at to consider your determination, what that documentation actually showed, and then what was the decision that you made based on everything that you reviewed. So we recommend strongly that you use some kind of a financial assessment worksheet to make sure that you're actually covering all of these elements so that you're compliant with the regulation. So the worksheet should really include the date that you do the assessment. It should include all of the different sources of income that you've evaluated and the monthly amount of that income. You'll need to show which documents the participant shows in order to verify their income. You'll need to have the general assistance or general relief benefit level for your county identified. You'll also need to identify whatever the income is that represents 35% of the median income for your county. And then most important is to record the results of that assessment to see which fee option the participant is going to be eligible for. Now we have created a template that includes all of these elements that is available for you all as providers to use if you wish. It's totally optional. You do not have to use this template, but you are welcome to it. If you do choose to use your own template, you just want to ensure that all of these elements are covered on your whatever worksheet you choose to use. So here's what our template looks like that we can provide to you if you desire. And you can see it's got a few different sections here. And we have the source of income. We document all of those valid sources exactly as it's defined by the regulation. We have a place to record which verification document we looked at, and then a place to actually compute which payment plan they're going to be qualified for. So again, this is an optional template for you to use. If you would like to use this template, you just let us know and we're happy to send you a copy of that. And you can use it as it is, or you can cut and paste and use elements of it, however you wish to document the assessment. All right, so let us now look at some of the details of the different type of valid documentation and how we interpret and verify or document the income that it shows on those verification documents. So the first thing that we'll look at is documenting GA or GR income. So Section 9879 F1 tells us that if a participant provides an award letter that confirms their eligibility for GA or GR, that you guys as the providers cannot require any other documentation of income. This applies even if you suspect that they have other income. I hear that a lot. Well, he drove up in his Lexus, but he says he's on GA or GR. Does not matter. If they present evidence that they are receiving general assistance or general relief, they don't have to show any other verification of income. So this also is valid. They can bring GA/GR documentation from any county. And what you'll do is you'll take whatever number that income is that they receive in GA or GR, whatever that income is, you'll just make a note of that on your worksheet under the heading of GA or GR. You'll put that on your worksheet, document what that income is. And it's important here to note also that even if all they're bringing is GA documentation, you still have to do the financial assessment and you still have to record that you've done the assessment. So even if they bring GA documentation and you know they're going to qualify for the $5 a month plan, you still need to document and record that you've made that assessment. So this is why no matter what their GA letter shows, you'll go ahead and just put that income amount on your worksheet so you've recorded that. So here's an example of a GA benefit, monthly benefit verification. And you'll see that it lists the different months and the amount of GA that they're receiving that month. And you'll want to make sure that the benefit is current. So you'll look at the date at the top of the letter and compare it to the date that the benefit is listed at. Okay, what if they're not on GA or GR? Section 9879 F2 tells us that if they don't have a GA letter, that you can require that they provide some other types of documentation. And the next type of documentation that we see and that is allowed is an award letter from a county welfare department or other government agency that documents that they're eligible for some other kind of public assistance, and it indicates the income level on which that eligibility was based. So that bolding there, I put that there because this is a really critical piece that helps you understand what their income is and how they're going to qualify for which payment option. So there are several types of benefits that are provided by the county, public assistance, that don't necessarily automatically qualify someone for a certain payment option. So for instance, Medi-Cal and CalFresh don't automatically qualify for participants for anything, but those benefit letters, Those award letters, when someone gets an approval for either Medi-Cal or CalFresh, they get a letter that shows that they're approved, and it also shows the income level that the county used to make the determination that they were eligible for that benefit. That is the letter that you're looking for. It's the award letter that shows the income that their eligibility for the assistance was based on. That's different than the monthly benefit statement document. I have this one here. You can see the other columns. There's one for CalFresh. There's another one for Medi-Cal. This is the monthly benefit award letter. This is not the one that you would look at if someone says they're on CalFresh. You would want to see the award letter approving that benefit and what their income was. So CalFresh uses something that they call a budget document. If participants don't have this documentation on hand, they can request this from their county welfare department. And then anything, of course, if it's shown as a yearly amount, you're going to want to break that down into your monthly amount so you can record that on your worksheet as the monthly income amount. And you'll put that on your worksheet for the heading of undefined income on which their eligibility is based, because you don't actually know the source of the income that the county used, but you do know what they calculated. So here's an example of someone that's approved for CalFresh. And you can see on the left-hand side, the first page shows that their benefits for CalFresh are approved. And then the next page is the CalFresh budget. And I've highlighted here the first couple of lines. One shows their countable earned income and one shows their unearned income. So when you see this, you would combine both the earned and unearned income to get their total monthly amount. And in this case, you can see that this participant has zero income, and that is the income that you would document on your worksheet. All right, what about CalWorks? So CalWorks is another one that we see a lot. CalWorks is cash aid, and that one's based on the number of people in the household. Now, CalWorks provides, excuse me, they provide an award letter also, but it does not typically identify the income on which the eligibility was based. In that case, a participant can request what's called the income verification letter, and they can present that. Also, the monthly benefit statement does show the amount of cash aid that they require. And what we do there is, because it's based on the number of people in the household, we're going to divide whatever the benefit is by the number of people in the household in order to determine the participant's share of that income. And whatever that is, we'd put that on our worksheet under the CalWorks heading and the monthly amount. So here's an example of a CalWorks monthly benefit verification. And you can see in this example that the participant is receiving $884 in CalWorks, but there are two people in the household. So we would divide the $884 by 2, and this participant would have then a $442 monthly income. Now, when you're looking at these benefit statements for CalWorks, they call the household size unit size. You don't want to look at the column that actually says CF household size, because that's referring to CalFresh. You want to make sure you're looking at the cash aid unit size for the household size. So if they don't receive public benefits, there are other pieces of income documentation that you can look at. One of those is if they're working, you can examine their pay vouchers or their pay stubs that documents their earnings for the prior 2 months.
It did start at 10. Yeah.
Can you all mute yourselves, please?
Oh, I'm sorry.
I appreciate that. Thank you. So you'd look at their pay stubs or pay vouchers that shows their gross income, bonuses, tips, commissions, and then you'd calculate their monthly income from that. So if it's shown as a weekly amount, you'd multiply to get the monthly income. If it's shown as an annual amount, you'd divide by 12 to get the monthly income. And you want to be sure you're using the gross income, not the after-tax income, but their gross income. And then you'd go ahead and record that on your worksheet. All right, in addition to these things, you can also require income tax returns or a letter from the state franchise tax board that verifies their income for the prior tax year. So you can request an IRS transcript from the participant. So instead of a participant bringing, a whole 1040 with all of the pages of that, they can contact the IRS and get a transcript, which is just kind of a summary record of their federal tax data and will show at the very high level what their income is. You can also request an individual status letter from the franchise tax board, and that can be used to verify their income for the previous year. And a participant can get either one of those documents free of charge from either the IRS or the franchise tax board. And then whatever those documents show, you would just use that gross income and then calculate their monthly income from that and put that in the field for other, because we don't actually know the source of income for those. We just know what the total gross income would be. Right, you can also require that the participant sign a release of information that allows you to get the income and wage verification from the California State Employee Development Department. So EDD has a form that's used for that. It's called the Wage History Report. And I've provided a link here on this slide. It'll take you right to that form that it's the form that the participant would fill out that allows you to make this request. And it includes all of the instructions for how to submit that form and how that works. So you're welcome to use this link if you want to use this as a method to verify income. Whatever that wage history report shows, you would go ahead and record that as a monthly amount in your field for other. Again, you don't know the source of the income, so you just put it under other. All right, is there any other documentation that you can accept? Yes, you do, as a provider, have the option to accept other documentation other than what we've just talked about. But if you do choose to accept other documentation of income, we strongly recommend that you document your company's policy that identifies what is acceptable. This will ensure that every participant is treated fairly and equally, and that you're consistent in the application of the assessment across your company, no matter who's doing the assessment.
So sorry, we can't see the PowerPoint. It's literally super tiny.
Really?
Yeah.
I could see it, Andrea.
We could see it.
Yes.
Okay. So
I can see it. Mine's fine.
Okay. Thank you for the feedback. I appreciate
Same.
that.
I can read it fine in writing.
Okay. So I guess one person is maybe having a technical challenge there. Yeah. Okay. So again, doing this makes sure that everyone in your company is using the exact same criteria when you're evaluating participants' income verification documents. When you do choose to accept other verification documents, you want to use the valid sources of income to guide what documentation you'll accept. So again, the regulation is very specific about what counts as a valid source of income. So when you choose to accept other documentation, you'll want to refer back to those valid sources. So for instance, you can choose to accept a Social Security benefits letter, or an unemployment award letter, or maybe somebody receives alimony. You can accept the spousal support award letter. But you have to, whatever documentation you're accepting has to show that it comes from one of those valid sources of income. And then again, whatever documentation you're using, if it shows anything other than monthly income, you'll want to break that into whatever the monthly amount is, and then record it on your worksheet under the appropriate heading. All right, let's do another little quiz here. Can the DUI program require bank statements as proof of income? Yes or no? You guys think? Can you require bank statements as proof of income? Okay, most of you do know the answer to this is no. You cannot require bank statements as proof of income. Where'd my cursor? There it is. So Section 9879 F5 tells us that you cannot require documentation of income other than what we've just talked about above. So that would include, again, GAGR benefits, other public assistant benefit documentation that shows the income on which their eligibility was based, pay stubs or pay vouchers, income tax returns or franchise tax board verification of income, or a statement from a wage history report from the EDD, or the other optional documentation that you choose to accept that shows one of the valid sources of income. If the participant does not present one of those valid income documentation pieces, they must pay the full program fee. And again, you can let participants know that there are optional documentation that you will accept, but you cannot require them to bring any of those optional documents. And again, really important, whatever documentation you're accepting must show one of the valid sources of income. So bank statements don't show the source of income, and it would be very difficult to show evidence of compliance with this regulation if you were to accept a bank statement as proof of income from a participant. Again, document, document, document. You must document your assessment. This will provide evidence that you've only looked at valid sources of income according to what the law says, that it'll show evidence that whatever the total income was that you figured in order to make your payment schedule determination. It's going to justify whatever payment option that you're able to offer to the participant and their payment schedule. And it's going to show evidence that you complied with the law as it relates to the timelines required from time from request until the time of the assessment. Like we like to say in the auditing world, if you didn't document it, it didn't happen. So make sure you're documenting those assessments. All right, quiz number 4. Can a program set up payment plans to fit each individual's participant's ability to pay? Yes or no? Can you individualize payment plans for each participant? See what you guys think. Okay. Most of you know the answer to that is no. You cannot individualize participants' payment plans. Section 9878F tells us that there are only 4 options for payment plans for participants. And the outcome of a financial assessment is what determines which of those payment plans apply to that participant. So the choices are: they pay a maximum program fee of $5 a month, or they pay a full program fee using an extended payment schedule that's been approved by DHCS, or a reduced fee option as it's defined in 9879 F3E, and that has been approved by DHCS. Now, we didn't talk about reduced fee options in part 1 of the training because there are programs in California, most programs are not using this option, and we just kind of covered some highlights about these options in part 1, but we'll dive a little bit deeper into it here. And then, of course, the last option is that the participant pays the full program fee according to your standardized payment schedule that has been approved by DHCS. So let's look at the maximum $5 a month payment option. What 9878 F1 tells us is that if a participant shows that their monthly income is either equal to or less than whatever the GA benefit level is in your county, then they qualify for the $5 a month fee. Well, how do you know what the GA level is in your county? The regulation tells us that at least once a year, you need to get written notification of that GA level from your county alcohol and drug administrator or your county board of supervisors. But usually you're just going to contact your county representative and request that GA level. You need to retain a copy of that notification, that communication between you and the county, whatever they tell you that level, GA level is. And you're also going to send a copy of that to us here at DHCS by October 1st. Okay, so if a participant presents evidence that they're receiving GA or GR in your county, then they're definitely going to qualify for the $5 a month fee per section 9878 F1. Of course, you'll want to verify first that the benefit is current, right? Like here's an example of a benefit award letter where you look at the date of the letter and you look at the date for the award and you see that there is no award for that month. So in this case, this participant would not qualify for the $5 a month plan, even though they have the benefit letter. So when you do get a GA letter or a GA benefit letter, you're still going to record that information on your worksheet. And then you'll record the, their GA level. This is an example from LA County. So the GA level is $221. And if a participant is on GA and they get the $221, you would then be able to see that that income is less than or equal to the GA benefit level for that county, and they would qualify for the maximum $5 a month program fee. Now, in your worksheet, you're going to want to make sure that you pre-fill out what is your GA benefit level in your county and also the percent of median income for your county, because every time you do a financial assessment, you're going to be comparing those figures. So you'll want to just fill those in on your template. If there is not a GA benefit level set in your county, then you use $300 as that threshold. All right, quiz number 5. GA or GR must be from the county that the program are in order to qualify for the $5 a month plan. Is that true or false? I have to be getting GA from the county that I'm in, that the program is in order to qualify for $5 a month. What do you guys think? Okay, kind of split on this one. This one creates a lot of questions out there in the world. So actually, you do not have to be on GA from the county that the program is in, because the regulation just says that I have to have income at or below the GA level. It doesn't say I have to be on GA in that county. So again, we're just going to use the income that's reported on the GA benefit, and we're going to put that on our worksheet, and then we're going to compare that income to what our GA benefit level is. So in this example, we're using, let's say we're a program in LA. Our GA benefit level in Los Angeles is $221. So we filled that out on our worksheet. But I'm a participant coming from Ventura County, and I get GA in Ventura County. And that shows that my monthly benefit is $310. So in this case, you're going to record that the GA level or the GA benefit that they're receiving is $310. You're going to compare that to the benefit level in your county. So is $310 equal to or less than $221? No, it is not. So in this case, the participant would not qualify for the $5 a month plan. But it's not because they have GA from another county. It's because their income is above the threshold for the $5 a month plan in your county. Okay, how about this one? Does a participant have to be on GA or GR from any county to qualify for the $5 a month plan? Yes or no? Do they have to be on some kind of GA or GR to get the $5 a month? Guys think. Okay, most of you know, it looks like the answer to that is no. A participant does not have to be on GA or GR to qualify for $5 a month. Again, the regulation tells us that a participant simply has to have income either at or below that GA level in your county. So again, we look at their income per month. And in this example, we'll go back to that person receiving CalWORKs. They had $884 in CalWORKs in a household of 2. So their share of that was $442. And in this particular county, we put their income as $442. In this particular county, the GA level is $687. So this participant would qualify for the $5 a month plan, even though they're not on GA or GR. Or the same with that benefit letter we looked at from the CalFresh participant. Their income had shown $0, so they also would qualify for a $5 a month plan. Not because they were receiving CalFresh, but because that public assistance benefit letter showed that their income was 0. Again, if you'll see on these examples that the worksheet has a place to record, the yes or the no, did they qualify or did they not qualify? This is again showing evidence that you're meeting the requirements of Section 9879. All right, what about this? A participant that's on GA comes to your program and wants to enroll, but the program already has many, many participants that are on the $5 a month plan. Can you send this participant to another program? Yes or no? All right, good. I'm glad you guys got this one. The answer to this is no. You cannot decide you have too many participants on the $5 a month plan and send participants elsewhere. Section 9879B2 is very clear about this, that you cannot deny services to a participant based on the results of the financial assessment. So if you find that they can't pay the full program fee, you cannot turn them away. You can't reject them, and you can't send them to other programs. You must enroll them according to the payment schedule that they qualify for. All right, so let's move on from GAGR and talk about a couple of the other payment options. One is the extended payment option. The other is the reduced fee option. And either of these options, they're both based on income that is less than or equal to 35% of the median income for your county. So if they receive income less than or equal to 35% of the median income in your county, they qualify for either extended payments or the reduced fee option. So you as the provider get to choose which option you're going to offer to your participants, but whichever option you elect, that is the option that you'll use for all participants that qualify. So you tell us here at DHCS which of those options you'll be using, and you do that typically as part of your fee increase request packages. So you let us know which option you're going to use. And then if at some point you change your mind, like you're currently using extended payment plan, but then you decide you'd prefer to offer the reduced fee option, you can do that. You just need to let us here at DHCS know, and we'll approve that change. So the first thing to do is to determine the median income in your county. And you do that by looking at the census figures. We use this a table that comes from the U.S. Census Bureau. I've provided a link for that there. It's not the most user-friendly table, but there are different filters so you can identify your county and then look at the median income that is provided from that. And then you'll take whatever that annual median income is, you'll multiply that by 0.35 to get the 35%, and then you'll divide it by 12 to determine the monthly income, the monthly amount, and that will be the threshold to qualify for either the extended or reduced payment plan. So here's an example for how you'd figure that 35% of median income. In LA County, the median income is $90,845. So we'll multiply that figure by 0.35 and come up with $31,795.75. Then we'll take that and divide that by 12. And that tells us the monthly income is $2,650. That's the threshold that people in LA County, if they make less than or equal to $2,650 per month, they're qualified for either the extended or the reduced fee option. So your worksheet, again, is going to record that eligibility. And please note that when you're offering an extended payment plan, when you're using that option, if a participant qualifies for that, you cannot require that they pay a down payment that is more than the cost of enrolling the participant. So the cost of enrolling the participant based on your approved fee for services. And then also remember that if you offer an extended payment plan, that only extends the payments from the participant. It does not extend the program services. So you can't stretch out the length of the program services to match the payment plan. It only extends their payments. So they'll finish the program before they're done paying. All right, so what is this reduced fee option? This is another calculation, again, that's based on that 35% of the median income for your county. And what you're going to do here is you're going to figure out what the incomes or what the participant's income is as a percentage of that 35% of the median income. So the first thing you'll do is you'll divide the participant's gross income by that 35% of the county median income to determine the percentage of the program fee that that participant will pay. And then you'll multiply that percentage by whatever your standard program fee is, and that then determines what the participant's reduced fee will be. So that's a big mouthful. Let's look at how we actually do this. So in this case, we need to know their gross income, 35% of the median income, what your standard program fee is. So we take that gross monthly income of $2,400, we divide it by the 35% of the median income. So we divide 2,400 by 2,650, and that gives us 91%. Then we multiply the 91% by whatever your standard program fee is for that length of program, in this case, 1,300. And we see that 91% times 1,300 is 1,183. So in this case, the participant would pay a reduced fee of $1,183 for the 9-month program. So that calculation is provided as a line on the financial assessment worksheet that we can provide for you. All right, quiz number 8. A program does not have to do a financial assessment for everybody that wants an extended, an extended payment plan. You as a provider can offer the extended payment plan to anyone that wants it. Is that true or false? Ah, excellent. You all knew the answer to this one. All right, so that is correct. You cannot offer it to everyone just because they want one. Section 9878 F4 tells us that if a participant's monthly income is more than that threshold number of 35% of the median income for your county, a participant must pay according to the standardized payment schedule. And again, you're only going to know if their income meets the criteria for an extended payment plan if you do a financial assessment. So you've got to do that assessment, make the income determination, and then you'll know if they qualify for an extended payment plan, or if their income is too high, then they have to pay according to the standardized payment plan, even if it's just a little bit higher than the median income. So you have to use that threshold. All right, let's talk about financial reassessments. So can a program require GA participants to provide their GA benefit documentation every month? Is that true or false? You can require them to provide their GA documentation every month. Okay, most of you guys, pretty much everybody knows that this is a true statement. And in fact, you can require that they provide their GA benefit documentation every month. Here is the caveat to that. So yes, you as the program can request at any time a financial assessment with the participant, but you cannot do that more frequently than every 30 days. And you typically are going to want to do a reassessment to reassess their fee option eligibility, so see if they continue to qualify for the $5 a month, or if a participant has some change in their financial situation, which may make them eligible for an adjustment of either their fee or their payment schedule. But here's the thing, when you do a financial reassessment, you follow the exact same process that you would for any other financial assessment. So if you're going to reassess a participant's eligibility for the $5 a month plan, what you're really doing is a financial reassessment. So you'll need to go through the financial assessment process. Now, because of that, you'll probably want to base your frequency of reassessment on the type of benefit documentation that a participant is providing to you. So for instance, GA benefits, depending on the county, those may be issued and reviewed monthly, quarterly, or sometimes even longer, depending on the county. So if a participant is going to be receiving GA benefits for the next 4 or 5 months, it wouldn't make sense for you as the program to go through the overhead of performing a financial assessment every 30 days when they already have the benefit awarded for a designated period of time. CalWorks, for instance, someone that brings that award letter, that gets awarded every 6 months. So you wouldn't want to reevaluate them sooner than every 6 months because they would simply bring in the exact same piece of paper that shows they were approved for CalWorks. And it would be a lot of effort on your part as the program to have to go through that whole documentation process for that. Medi-Cal, if they use a Medi-Cal award showing their income, that gets awarded annually. Starting next year, they'll start doing every 6 months, but right now that's an annual award. So it wouldn't make sense again to reassess more frequently than that. The participant would just bring the exact same benefit verification. Same thing with CalFresh. They get reevaluated every 6 months with a new budget provided at that time. So you'll want, because of the overhead associated with performing a financial assessment, the request process, the documentation process, all of that, you may want to really pay attention to how frequently you do those assessments for your participants. In this case, we have someone that received general relief benefits, and you can see on this award letter that they begin receiving those benefits in March, and they've been approved for that through August. So in this participant's case, it would not make sense for you to do a financial reassessment for the months of April, May, June, July, and August, because they'll just bring this exact same letter. And it would be, again, the overhead on you guys to have to document that assessment for every month that you want to reassess. Another example where a participant has already been approved for multiple months in a row for GR. So it's important that you guys are using, of course, your own resources wisely to make sure that you're not creating additional work for yourself by having to do reassessments for benefits that are not changing. Of course, you're welcome to. You can always do the reassessment every 30 days. That's up to you. But okay, so let's look at quiz number 10. A participant does not submit their GA paperwork for the month. Can you automatically begin charging standard program fees for that participant? Yes or no? They don't bring their GA paperwork. Can you start charging standard program fees? Okay, so I see that most of you think that you can do that, but that in fact is not correct. You cannot automatically begin charging standard program fees just because a participant didn't bring their GA paperwork for the month. Again, if you're going to examine their eligibility every month, what you're actually doing is a financial reassessment. And that reassessment has to be conducted just like any other financial assessment. So you'd have to make the request for the assessment, schedule it within 5 days, review and evaluate their income documentation, document the results of that, and only then, if the payment plan changes, then you have to create an amended or a new payment agreement. So if you do a reassessment and it results in the $5 a month fee, you can still, and so let's say a participant's been attending for a few months and then they bring in documentation and now they qualify for the $5 a month fee. Any of the services that they received prior to the time that they have become eligible for the $5 a month, you can still, of course, charge for those services at your standard approved fee-for-service rate and payment schedule. And then conversely, if a participant loses their eligibility for the $5 a month rate, you cannot go back and require payment of services that they did receive while they were under the $5 a month rate. here's the really critical thing, you guys, that you have to remember when it comes to somebody losing their GR benefits, is that you must amend their payment contract when their fees change. So if they are going to go from a $5 a month plan and now you need to charge them standard fees because they don't have GA benefits anymore, you have to create a new payment agreement or amend their payment contract. The new fees are not effective until you've got that amended contract. So you can't just automatically start charging them standard program fees. You have to go through the assessment process. You have to document that they're no longer eligible for GA or GR and what their income is. And then, and only then, can you change their contract and have them start paying the full program fee. Very important. All right, so you've gone through all of this financial assessment process. Now you have to store those records. You have to keep all of the records relating to the financial assessment in the participant file. And this includes that written financial assessment request. It includes all of the documents that you've used to verify their income. And it includes your worksheet or document that you're using to actually show what your assessment was. That has to be kept for every participant. And that includes participants that asked for the financial assessment, but then ended up not enrolling. Because again, that definition of participants in both section 9878 and 9879 tells us that a participant is anyone that either has enrolled or is in the process of enrolling. So just because someone ended up not enrolling, you still have to keep that financial assessment documentation. And we will ask to see those files when we come visit you guys for audits. So it's a good idea to definitely, have those files somewhere and to be able to keep track of which participants have had a financial assessment so that when you're asked to present evidence of those, you can readily show those to your auditor. Okay, so when we're out there in the wild, we see several different types of deficiencies that have come up repeatedly as we're visiting you guys. And hopefully after these trainings, we won't be finding these deficiencies out there anymore. But some of the categories of deficiencies, they kind of fall into three categories. One is a violation of participant rights. This is where we see participants that are being deterred from pursuing financial assessments at all, being told that they're not offered at this program or they're not qualified even before they have a financial assessment. We see where participants are being denied service if they're on GA or GR, or they're being sent to other programs. We're seeing where participants are told that they have to be on GA in order to qualify for the $5 a month plan. So those are violation of participants' rights, and we really don't want to be doing that. So hopefully this training has helped to understand what those rights are and ensure that you'll be compliant. We also see record-keeping deficiencies. These are probably the most common. Folks are doing financial assessments, but you just aren't having the records that are showing evidence that you're compliant in doing those. So this is where we see like there's no financial assessment request being able to show when that request happened. So an absence of those requests. We see where there's no evidence that the financial assessment was actually conducted, or it can't demonstrate that it was done within the 5-day time window. No documentation at all of the assessment, though we might see a payment schedule that shows that maybe there was an assessment, but there's no documentation of that assessment in a file. We sometimes see where there'll be like GA documentation in the file, and maybe a participant on the $5 a month fee, but there is no record of the request or the assessment in the file. So again, just because somebody's on GAGR, you still have to go through that assessment process and have all of the documentation to support that. We see, this is one we've seen a lot. It's just been, I think folks haven't really known that you have to keep those financial assessments for participants that chose not to enroll. So we see a lack of those out being kept by the programs. We also see payment agreement and contract deficiencies. Programs that have been providing extended payment plans for anyone that wants one. We see a lot of times where the payment agreement contracts are not being amended after the financial assessment. So again, really critical, you have to amend those contracts to show whatever their fee is going to be. We see where delinquent notices aren't providing the required information about financial assessments. And we see where participants are being suspended, but are not being given notice of the suspension according to the regulation. So again, I hope that the information that we provided in the previous presentation and what we've provided here today is helpful to answer the questions that you have about how to perform financial assessments, what the expectations are for that, what DHCS will be looking at when we visit you, and that you're all able to understand and comply with the requirements. So with that being said, we've reached the end of the slideshow presentation, and we will open it up now to questions, and my colleague Yuvi is going to help me with that. She'll read your questions, and we'll see what we come up with for an answer. All right.
All right. So the first question, somebody wants to know, does student loans count as income?
This is a good question. So a student loan is not an educational grant or a stipend, and it's not one of the valid sources of income that's listed in Section 9879. So the answer to that is going to be no.
Can a live-in girlfriend/boyfriend income count if they have their name on paperwork that they've been applying for assistance?
No. Again, a live-in boyfriend or girlfriend is not someone that is legally required to support the participant, so we cannot include their income in our calculation.
What about TANF?
That one, I am not familiar with which government assistance program that is. That one I'll have to put to the side and answer more specifically in an email. I'm not sure about that one.
What should be done if an individual does not have any documentation?
Yes, good question. So if a participant does not present documentation of their income, they must be charged the full standardized program fee according to the standard payment schedule.
Is there any consideration of changing the amount of income that would qualify a participant for extended payments when changes are made to Title IX? 35% of median family income is pretty low, and many participants who make over that amount need the extended payment plan because of the high cost of living in California.
Yeah, we see that a lot, right? And we have big hearts. We're in this industry because we want to help people, and it can be really hard to see folks, are struggling financially, and we still have to charge the standardized program fee. So when we when we're reevaluating Title IX for a revision, we probably will look at that, but I don't know what the outcome will be for sure. But I hear you. I know that's really tough. But we still, right now, we have to follow the law. So even though we know it's a struggle for some folks, we have to charge the fees according to the regulation.
What if the GA or GR is more than the level?
So in that case, if someone's income based on GAGR is more than the GAGR income level for your county, then they would not qualify for the $5 a month plan. And you'll know that when you record it on your worksheet, right? What is their income level? And then what is the GA level in your county? And if it's more than whatever that is in your county, then they will not qualify.
The award letter states more than $336 allowed. So would this automatically deny them for the reduced fee?
Okay, I'm not sure I understand the question. Can you read it again, Yuvi?
The award letter states more than $336 allowed. So would this automatically deny them for the reduced fee?
Okay, so if what I'm assuming you mean here is that in your county, the GA benefit level is $336. So if someone has income, their income verification shows more than that $336, then they would not qualify for the $5 a month fee.
When a client comes in with CalFresh income breakdown form and they make under the $327 monthly income, they would be placed under GA. How would they bring verification every month when the county workers do not give them another one of those
Right.
documents?
Right. So this goes back to that idea of reassessment, right? They can bring the exact same letter every month if that's what you want them to do, but those benefits are awarded for 6-month periods. And again, if you want them to bring that verification every month, you're welcome to ask them to do that. But when you do that, what you're doing is you are requesting a financial reassessment, which means that you have to go through the process of documenting all of it from the request through the assessment and what the payment determination is. So you want to use your resources wisely and know that if a participant's benefits are not going to change for 6 months, you probably don't want to go through the process of doing a financial assessment for them every month.
When using the budget document, do we have to reassess the client monthly? If so, which document could clients bring in?
Again, CalFresh awards benefits every 6 months. So you're welcome to do a reassessment every month for 6 months, but the participant will not have any other benefit documentation to show you other than that budget letter that gets awarded that gets provided every 6 months.
How does a tax return from the prior year indicate what they are making this year?
Yeah, this is a tricky one. It doesn't seem to make a lot of logical sense because it does not show what they're making this year, but the regulation says that we can make their income determination based on the prior year's tax return.
And I just wanted to add one thing about that. I think the regulation might appear to try to recognize not everyone can provide current pay stubs or proof of public assistance. For example, someone who might be self-employed, a seasonal worker, or someone who changes jobs frequently. So I think the best approach is really just, while it may not reflect the income, it does provide some type of verifiable record of earnings.
Thank you for that clarification, Glenn. That's helpful.
What happens with food stamps only? Without working, no income, but receive food stamps only, but they can provide their benefits letter and provide SSI benefits letter and EDD letter.
Okay, so again, just being on food stamps or showing that, they receive like $200 in food stamps a month, that alone does not qualify them for a payment option. You have to see the income level on which their benefits were based. And with food stamps or CalFresh, that award letter is issued every 6 months. And it shows with the award letter, it shows their budget, which is the income on which that was based. If you as a program choose to accept other documentation like SSI or the EDD documentation, unemployment documentation, you're welcome to accept that also, and you'd record the amounts that the participant receives on your worksheet. You'd total all of those different amounts, and that would be their total income for the month. And then you'd compare that to whatever the GAGR amount is, or the 35% of your median income for the county.
If we use the budget document, it must have an amount to qualify, or can it be zero? Or can it not be zero?
So if the budget document shows total income of 0, that is the participant's total income that you will put on your worksheet. The county has determined that their income is 0, so that is the number you'll use for determination of payment option.
If you cannot ask for a bank statement, how do you check if they are getting a paycheck? I had a client who said they were not working, and when I asked for their bank statement, it showed that they were working at Macy's.
Okay, so if a participant doesn't provide documentation of income, then they must be charged the full fee. So when you tell a participant that they can bring their pay stubs and they choose not to bring their pay stubs because they don't want you to know that they're working, if they don't bring the documentation, you must charge them the full fee.
What if they get paid via Zelle for cleaning houses?
That's a good one. That's similar to asking for a bank statement. So again, unless you can validate the income source, it's very difficult to use that documentation to identify a participant's income. And something like Zelle, that's similar to a bank statement. Although we do have, right, we have folks that receive something Venmo, and if there's the little note on the Venmo that says, house cleaning, I would consider that similar to a pay stub. But if it's just like a general, like a bank statement, you're not going to be able to verify the source of the income.
What if they are an online seller and the only verification of income is their bank statements showing the income, showing the incoming online transactions?
So again, unless we can verify what the source of the income is, a bank statement is a very difficult piece of documentation to be able to use.
Can a program decline to accept a specific income verification document that is identified by law as acceptable, and if reassessment is required and they use documentation that doesn't change for a period of time, such as income tax return, what is acceptable as reassessment documentation?
So the items of documentation that we talked about, which are the GAGR, public assistance, income taxes, EDD, or the other documentation of income that show one of the valid sources of income. If if it's one of those documents, then you can accept it. If they don't have one of those documents, then they pay the full program fee, but you must accept those documents, right? If it's any of those required documents, like an income tax return, you must accept that as documentation. Even if it's now November and they have last year's tax return, that still constitutes a valid piece of documentation to verify income. So you cannot refuse that situation. You would have to accept that income documentation.
When the program submits a wage verification request to an outside agency, can we extend the 5-day time limit if we're waiting on a response from them? What would we do in this case?
I would suggest that in that case, yes, if you show that you've submitted that request, but document. So make sure that's noted, that the participant also accepts that you're waiting for that, and just make sure that that's in the file. But if it shows that you're in the process and you're waiting for something, outside your control, I think we're all going to be okay with that, as long as you're documenting that in the file.
If a client is past due and they do a financial assessment, how do we address the past due balance?
Excellent question. So if you do a financial assessment and you find that the participant, let's say, is now qualified for the $5 a month fee and they have a past due balance, they still owe the past due balance as it stands at the time of the reassessment.
Our county requires us to submit GR verification to waive the county fee. Is the county not required to waive the county fee if the participant does not have GR?
So that I'm not sure how to answer that question. I was not aware that counties waive their, I guess it makes sense they're going to waive their fee for the GAGR. So what was the second half of that question, Yuvi?
Is the county not required to waive county fee if the participant does not have GR?
So I'm guessing you mean an extended payment plan or the standardized plan? I'm not quite sure how to answer that question.
I think they're maybe asking like if they don't have that award letter, or if they qualify still for the $5 fee, but they don't have that award letter from GAGR. I'm assuming that's what they're asking for.
Okay. So again, I'm not sure how you have things structured with the county, but the way the regulation reads is a participant does not have to be on GAGR to qualify for the $5 a month plan. It's again based on the income at or below that level. So if that is what the county is basing their requirement on, then again, it would be based on that income level, not on whether or not it was specifically GAGR. But again, I am not 100% certain what the requirements are in your county, so it's probably best to check with your county representative to answer that specifically.
Can you terminate a client if they are on the extended waiver and finishes classes, but then does not pay the rest of their payments?
No, Title IX is very clear in Section 9886 that you cannot terminate a participant that has completed their program but not paid their fees.
Please clarify how it is determined what the cost of enrolling the participant in the program.
So this is broken out on your fee for service computation, and it's typically what you guys will call your intake fee and your county fee, your state fee, And sometimes, depending on when you do your assessment, sometimes that's done as part of the whole intake process. Some programs do it separately. So whatever is all of your intake enrollment, the combination of those fees that you have outlined when you've done your fee increase requests, that is your enrollment fee.
Can we withhold the DL 101 until after the extended payment plan is fully paid off?
Yes, in fact, you must hold off. You do not submit the DL 101 until they have both completed all their requirements and paid all of their fees.
I know there is a minimum amount of additional payments for extended payment plan. Is there an upper limit to how many additional payments the program can add to the extended payment plan if a client would benefit from an even lower monthly payment?
So there is not a length on what the maximum number of months is for a participant to pay. There is a minimum length, but there's not a maximum. But the thing you have to remember here is that whatever your extended payment plan is, that has to have been approved by DHCS. So you can have different options for different ranges of months, but those have to be approved by DHCS before you can offer them to participants.
If you initially determine eligibility on the 15th of a month, does that mean that you have to wait until the 15th of the following month to reassess?
Yes.
If a client verbally contradicts info from their documentation, for example, they bring in tax returns but verbally say they have other income not reported on the tax document, do we still have to go by the documentation?
Yes.
What if the benefit stops and they say that they do not have any income still? Would they be placed in a standard payment plan?
Yes.
Does the financial assessment document that indicates what the fees will be based on the assessment count as the change of the change of the contract once signed, or is it the full contract that needs to be reviewed and showing?
Okay. So the financial assessment worksheet does not constitute an amendment to the payment agreement. You must have either an amended payment contract or a new payment contract whenever you change the participants' fees or payment schedules. So depending on the structure of your contract, if your payment agreement is part of your full contract or it's a separate agreement, will depend on, that will determine what you're amending. But you definitely have to have the portion that's relating to their fee payment agreement that needs to be amended or a new one created with the new fee or payment schedule.
Does the financial assessment document, sorry, I already read that one. Okay, next one. You have you you have do you have to do a computation sheet and only charge for the remainder of the fees if they no longer qualify, correct? And then charge for any additional fees if needed?
Make sure I understand that. So a participant's program fee is changing, then yes, you would do a fee for service calculation to determine what fees are left to be paid after that. Yes.
If they provide tax return, if they provide a tax return and or transcript for the original assessment and qualify for a fee waiver, what documentation can we ask for to reassess them in 30 days if they still have no income?
You can ask them, you can request a financial assessment from the participant, and the participant can bring in the exact same tax return that they brought in the first time, and that is the document that you would use to reassess. So again, this is where you'll want to pay attention to what documentation they're providing in order to determine how frequently you will want to go through that reassessment process. Because if a participant has a tax return that showed $0 for last year, then they can bring that exact same tax return every month this year and qualify. And you would not want to go through the process to reassess them every month when they're going to have exactly the same documentation. So you'll want to pay attention to what document are they bringing and how long will that document qualify them for whatever their fee or payment schedule is, and only reassess when it makes sense.
If a participant states that finances may be a barrier to completion in the face-to-face, and the counselor refers them to the office to request a financial assessment, is this sufficient?
Yes, as long as you've informed the participant what the process is for them to request a financial assessment, then yes, then that's fair. I would make a note in that case, right? If you're the counselor and you're told the participant that, make the note that you referred them to the office for a financial assessment request.
If a participant states that they currently have no income, but provide a tax return from the prior year, how are we supposed to verify that they currently have no income?
Yes, you cannot verify that they currently have no income if they provide last year's tax return showing income. If they're if they're trying to use the fact that they have no income currently as the basis for the determination, then they will have to have something that shows that they currently have no income.
Can you define the length of time for a standardized payment schedule?
Yes, that is defined in section 9878. It's very clear exactly how many months a participant has to pay their program fees. And I'm not going to be able to successfully rattle it off the top of my head, but a participant basically has the length, whatever their program length is, that's how many months they have to pay their program fees.
Can you have multiple options participants can choose from the different lengths of time under the standardized payment plan schedule?
Yes, but the plan has to be approved by DHCS, and every participant must have the same opportunity to select.
Can you define the max length of time for an extended payment plan schedule?
No, there is no maximum length. There is a minimum length, but no maximum length.
How is using a tax form a qualified document when we usually require monthly documentation?
So this idea that we require monthly documentation, that is something that you as a program have decided to do. That is not a requirement of Title IX. So again, it would make sense to pay attention to whatever the income documentation is that is being provided by the participant, and make a determination about how often to reassess their fees based on whatever type of documentation they're providing and the length of time that that documentation is valid for.
Is it only CalWORKs we can divide the income per household member, or say a single mom with employment income be divided?
No, it's only CalWORKs that we divide by household size.
And somebody here is letting us know that TANF is tribal support.
Ah, yeah, if that would be probably falling under the definition then of other governmental aid. And I'm not sure if that's a cash award or exactly how that works, but will probably follow along the same lines as the other public assistance, where you would base their income on the income which made them eligible for the benefit. So I'm sure, again, there will be some sort of an approval letter coming from the agency that's documenting that. You'd use that.
How do you handle someone who owes past program fees and then requests a financial assessment and qualifies for the $5 a month?
Okay. Again, anything that they owe for services that they received prior to that financial assessment, they still owe the full fee according to your fee for service for those services.
If a client is receiving general assistance, fails to submit their award letter for several months, but was eligible in receiving benefits during that period, can fees be applied retroactively once the award letter is provided?
So again, the payment schedule becomes effective at the time of the assessment if a new contract is signed at that time. So it would not be retroactive. It would be moving forward from the date of the assessment if that is the same day that a new contract, fee contract is signed.
What information is required to be given to the client prior to the financial assessment?
Okay, so this we covered in the part 1 of the presentation, but basically you need to let the participant know what are valid sources of income and what documentation is required in order to complete the assessment. We have a financial assessment request form. And they also have to submit a written request. So we have a financial assessment request document that includes all of those elements that we can send. Just send a note to your analyst and we'll send you that template that you can use.
What if a client was previously on our regular payment or the standard payment and gets terminated? He still owes us a balance for their previous balance, but comes in trying to reinstate and does provide GA proof. Will the client have to pay off their delinquency balance and then qualify for the GA once reinstating?
Yes. They are responsible for the full amount of their balance due, anything prior to that general assistance or the reinstatement. Yes.
If someone is unable to pay the extended payment plan schedule, but income is greater than GR, can you deny services? What do you do?
You cannot deny services to any participant that can't pay the full program fee. So a participant can opt not to enroll if they cannot afford it, but you can't deny them. They either will pay the full program fee, they'll pay according to an extended program fee, or if they qualify for the $5 a month fee, they'll pay according to that. But you have to base the payment option on what they're qualified for. And then beyond that, it's up to the participant if they choose to enroll based on that payment schedule.
If a client runs into temporary financial hardship and asks for a pause in payment or reduced payment for a short period of time, can the program accommodate the client as long as full program fee is paid by completion?
Okay, so this becomes one of those like tricky situations. So there's a couple of options here. You can do a financial assessment, and if the participant can show at that time a change in their income, then you would create a new payment plan, a new payment schedule, or the $5 a month fee, and that would be in effect until another change in their financial situation. And then when their financial situation changes again, you would do another reassessment and then charge the appropriate fee and payment schedule at that time. And of course, you do an amendment to their fee contract.
If they are awarded for a 6-month period but get a job or do not turn in their monthly documentation, then they lose benefits. Then they lose those benefits.
Okay, so if somebody is on, if someone provides a GA letter that says they're going to be receiving GA for the next 6 months, but they get a job before the end of that 6 months, then you would request from the participant, right? You as a program have the right to request a financial assessment. So you would let the participant know that you're going to do another financial, or you're going to do a financial reassessment, and they would need to bring their current documentation of income. And then based on that documentation of income, you would determine what they're eligible for a payment plan. You would amend the contract with the new payment plan.
What if your program is serving counties that have no DUI program and the GAGR benefits are more? Do we still deny them the fee waiver even though they are attending in a different county due to something out of their control?
That is a really good question. Yeah, I have not run into that in the wild before. That one I would like to just get a little bit more information on before answering. That's a good question.
Does a financial reassessment have to be an appointment with the client? Does a reassessment have to happen every month for GA clients or just documentation submission?
So if you're requesting documentation from a participant to show what their income is, basically what you're doing is requesting a financial reassessment. And if you do that, you need to go through the whole financial assessment process, where you have a date of that the financial assessment will be conducted, and you keep records and documentation of all of the documentation of the income verification that's received, and then the outcome of the financial assessment. So if you choose to do that every month, you're welcome to do that every month, or you may want to consider doing it only according to the frequency of whatever documentation they've provided.
Can you require the participant to submit documentation prior to scheduling the financial assistance interview?
So no, the financial documentation is not really required until the appointment, now some programs are not doing an actual like sit down interview. They're doing hey, you submit the documentation and we'll let you know what the results of the assessment are. And all of that's happening at least within the 5 days. You can do it like that, but if you're doing like an interview, come for your financial assessment interview, then you would have the documentation at that time.
I have a client who provides GA documents receiving over $500 per month on the GAGR column, but that is above the baseline standard of A for GA in the county. Do they still qualify for the $5 a month program costs? How do they receive that much? Is that document altered?
So that's a good question. I don't understand how a participant would receive more than the GA benefit level in that county. That would be a question for someone in the county services office that provides GA. But no, the requirement has nothing to do with GA itself. It has to do with the income level. So if a participant's income is above whatever the GA level is for your county, then they do not qualify for the $5 a month fee.
So for clarification, I understand that food stamps is not income, but a lot of clients come from treatment programs. So if they provide only proof of food stamps in their SSI letter and EDD benefits, then it's a no, we cannot accept this because it's not income.
So if a participant has an SSI letter and an EDD letter that show income, you are, as a program, able to accept those as optional documents. If you choose to accept those as optional documents, you should have that written in a policy somewhere for your company that identifies that you're accepting SSI letters and EDD letters as valid sources of documentation.
If a client applies for financial assessment while on 15-day or 30 days of suspension, they still owe the past fee. And then moving forward, they will start the $5 fee.
Correct. If that's what they qualify for, correct. They would still owe the past due fees at the standard fee for service rate, and then anything going forward, they would pay at the new rate.
A couple people are asking about obtaining a passport for the first training. How do they go?
Passport for the first what?
Training? I'm
Passport.
guessing for like the slide decks.
Oh, so the slides for the first presentation were sent out to whoever we have on record for the program administrator for your program. So that was sent out. So if that didn't filter to you, please just shoot us an email here at DUI Providers at dhcs.ca.gov or your program analyst, and we'll make sure that we send that to you.
But some of them are saying that it's requiring a password.
Oh. Yeah, so we attempted to send a link for the video recording, and what we found out was that there was this issue, right? This technical issue out in the field with you guys, that it was requiring this password. So we sent a follow-up to that saying, oops, it's not going to work. We're taking care of that internally. We're working on that right now. And as soon as we have a link to the video available, we'll resend that out. So if the link you're clicking on is asking for a password, yeah, that was a technical limitation we didn't realize was going to happen out there. So please stand by. You will get notification as soon as we have that video available without a password.
How about a person who is terminated the program on regular fees and requests to come back and reinstate with a financial assessment and qualify? Do they owe past fees and then use the restatement fee as the FA fee?
Yes. So again, past due fees are always owed at whatever rate was in effect when they had the services. So past due fees would have to be paid before they reinstate, and then they could reinstate with the $5 a month fee if that's what they qualify for.
Please reiterate the point of absence of unenrolled / potential participant financial assessment.
Okay, so again, Title IX defines a participant as either someone that has enrolled or someone in the process of enrolling in your program. So a participant that comes in and says they're not going to enroll until they get the financial assessment, and then they have the financial assessment and they decide not to enroll, Title IX still considers that person a participant that has had a financial assessment. So you have to maintain the file or the record of that assessment for that participant, even though they chose not to enroll.
If the program has to reduce costs for clients, why won't the state waive fees for these clients as well? We pay $50 for clients, example, but charge them $5 per month. AB 541 equals $15.
So that I can't answer that question. That's above my pay grade. Maybe Glenn has an answer for that.
You know, as we look into the making changes to the regulations, the fee structure is something that we're taking a look at. I can't speak to what those changes might be or when they might occur, but it is something we are taking a look at. We recognize in the field that there are challenges that the field's facing in regards to the financial situation, but yeah, it is something we are taking a look at.
Thank you, Glenn.
You're welcome. And I did want to add, we'll just take just 2 more questions. And at that point, feel free to go ahead and maybe send any questions you have directly to your analyst, and then we can get a response back to you. But
we've gone way over. Sorry, I didn't realize what time it was. Thanks you guys for sticking around. This is good stuff.
All right. What if clients come in for a reassessment and they cannot provide documents, but they refuse to sign the new contract stating their fees go back to full program fees?
Participants, you just never know. That's an excellent question. So I would probably, and hopefully that's not gonna happen in real life. But in a case like that, you may be able to provide a contract with a notation that the participant refused to sign. I'm not sure. Let me get back to you on that one. That's a good question.
Is the standard payment structure still a requirement for a reinstatement? Say a client owes $400, but our monthly fee is $210. Would we have to charge them $210, then the remaining $190, or could we split it to $200 for the remaining 2 months?
So Title IX says that participants have to pay according to the standard payment schedule. So whatever your standard payment schedule is, that's how you would have to set that up for that participant. Hey, thank you, Yuvi, for that. And thank you all so much for your participation and your attendance here. And again, if you have questions, anything we didn't get to here, or just as you go through your days and you're actually doing these assessments and things come up, please reach out to us here at either DUI Providers at dhcs.ca.gov or reach out to your analyst specifically, and we will answer your questions to ensure that you can all remain compliant. And yeah, so do stay in touch if you need to. Have a great day, everybody, and thanks for being here.
Thank you.